Yes, Paul. I think the key theme right now for most traders are just looking for a chance to reset shorts in the bear market. Most people are looking around 80. That was last year's highs, good levels. We're at 70 now. It's basically the apex of the bell curve of trading for 20 years. And just a question of what might stop it from a normal rotation back towards the lower in the range for the last 20 years. You know, my view is I still think it's going to do that. The key theme for that to potential happen is obviously a little more detente in the Middle East. But a little pressure in the stock market will do that. So right now the market's looking up at maybe its 200-day moving average around 74, 75. It's at 70 now. It's a bear market that's reset. And I just know I don't know what's going to make it go higher, something shocking, but normalization making it go lower. And that's basically what Mr. Trump needs for the midterm elections.
Why is it continuing to go lower? Because the Strait of Hormuz is still blocked off and the conflict has gone on, I think, a lot longer than anybody thought it would, or than most people thought it would. So why has oil not crept back up?
This whole rally accentuated the most powerful force in commodities that's only growing. That's price elasticity, particularly in crude oil. Now, we got that from Russia's invasion of Ukraine that really kicked in technology replacing crude oil and actually pressuring both sides for prices of supply and demand. And now it's kicking in now. I'm just updating an outlook for crude oil for Q3. And we see the surplus of U.S. and Canadian crude oil and liquid fuels approaching 9 million barrels a day. Just a few years ago, that was basically flat. That's for next year. So there's only one force that's going to stop that, and that's lower prices. So what this did is just shifted the people reiterating the price maker status is shifted from OPEC to the Western Hemisphere. And it's not just crude oil. We've had a pretty good peak this year in corns and potentially in soybeans and gold, silver, platinum, and palladium and iron ore. You see that trend there? The pump then dump trend is starting to trickle down. That's why I'm really worried about the stock market going down, because it's feeling to me very much like 2008.
When I think about the farmer, I think you've taught us kind of what to focus on: corn, soybeans, all that kind of stuff. Soybeans are up 15% year to date. That's good for the farmer, right?
It's great. It's just what they needed. It's hopium that the Chinese will come and buy more soybeans. They probably will, but it's not economic for them. So maybe state-run enterprises will do it for political reasons, because U.S. soybeans right now are a little bit more expensive there in Brazil. Remember, Brazil just had a big harvest, and we have more we planted this year, and the rain has been ample. So I'm really worried what soybeans have been doing for the last few years as they go down back below 10 or so. Right now, they're around 12 as we head towards the peak of the harvest in September and potential October. And same with corn. That December contract pumped up to near 5 just a couple months ago, and they got to a new contract low. It's bumping up again. And if the cycle's normal, we don't get a bad weather summer, which we're already getting plenty of rain, cycles are probably going to go lower. And particularly, it's all the same trade now with crude oil going lower, Paul.
Hey, 30 seconds left. For our steak lovers out there, I see cattle kind of flat for the year, up just a couple of percent. Have we seen peak cattle prices?
We might have. I think it's the typical high price cure kicking in. Now, we've had problems with inventories for a while and certain diseases and things, but it is peak driving season, peak consumption season, peak barbecue season.